In 1998, a currency snapped so violently that markets moved 20% in a matter of days, catching governments, banks, and entire populations completely off guard. Most people today have never heard the warnings that followed. But the same indicators that triggered that collapse are now flashing again. Only this time, they're bigger, faster, and global. The world is sleepwalking into a currency fracture that experts claim can't happen again. Yet the data suggests it already has, quietly, behind the scenes. The truth is hidden in plain sight. 1998 was a dress rehearsal. 2026 may be the main event. And if the pattern holds, we are months away from the moment everything breaks. What follows will blindside nearly everyone watching. It always begins quietly, so quietly that almost nobody notices. Not with alarms, not with breaking news, but with a subtle shift deep inside the machinery of global finance. A tightening you can't feel until it's too late. Because currency collapses don't start with chaos. They start with silence. That's the part most people never understand. Long before the headlines of 1998 screamed of collapsing economies and emergency bailouts, there were signs, tiny signals buried in the financial plumbing. The first warnings weren't dramatic at all. They appeared in the narrow space between what banks wanted to lend and what other banks needed to borrow. A small widening in obscure bond spreads. A slight distortion in liquidity ratios that only a handful of analysts even knew existed. And yet, that was the entire crisis announcing its arrival. The data was public. Anyone could have seen it. But nobody did. Because it didn't look like danger. Not yet. In 1998, central banks began describing these distortions as temporary imbalances. A harmless phrase, but also a confession. In the language of finance, temporary imbalance means something very specific. The system's plumbing is clogging. Interbank lending, the lifeblood of global currency stability, was weakening. Banks that always trusted each other suddenly hesitated. Collateral they once considered rock solid now came with questions attached. And when trust evaporates, liquidity evaporates with it. That was the first crack. It was invisible to the general public, but devastatingly clear to anyone watching funding markets. The flow of dollars, the currency the entire world needs, was drying up. And once dollar liquidity dries up, every country dependent on it becomes vulnerable to a snap. This is exactly how the 1998 collapse began. Fast forward to today, and the exact same signal is back. Cross-border dollar liquidity is draining again. The same spreads are widening. The same temporary imbalances are appearing in central bank statements. The same subtle freeze is forming in the same corners of the financial system. Most investors are staring in the wrong direction, watching stock indexes, crypto charts, or GDP forecasts, while the danger is quietly assembling behind the curtain, just like before. Because currency breaks don't begin when people panic. They begin when institutions stop trusting each other. And that moment has arrived again. Authorities are, once again, insisting everything is contained. It's the same word they used in 1998, the same word used in 2008, the same word used every time, right before the snap. Containment is the illusion that precedes every collapse. It reassures the public while signaling to insiders that the danger is real. Today, the world is sitting inside a dry forest of leverage, deficits, and foreign debt. While the quietest sparks are already burning. The same tremors, the same plumbing issues, the same pattern. And if history is repeating, as the data suggests, then the next stage in the script is already underway. Because in 1998, after these silent signals appeared, something else happened. Something far more dramatic, far more visible, and far more destructive. And that moment is about to return. What happened next in 1998 follows the same script unfolding right now. A currency never collapses the way people imagine. There's no slow slide, no gentle warning, no graceful decline. When it finally breaks, it breaks all at once, like a dry branch under too much weight. And in 1998, the world saw exactly how fast that snap can happen. It began with a tiny move, just 5%. Barely large enough to make international news, but just big enough to trigger margin calls for funds holding leveraged positions across Asia and Eastern Europe. What looked like a market adjustment was actually the first domino falling in a long chain of interconnected debt. Behind the scenes, banks were forcing borrowers to put up more collateral. That collateral didn't exist, so assets were sold, fast and at any price. Currencies don't fall because of panic. They fall because the math stops working. Then came the next wave. That initial 5% drop destabilized central banks already stretched thin defending their exchange rates. Reserves were drained, first slowly, then in a torrent. It wasn't speculation, it was survival. Every dollar spent propping up the currency was one less dollar available to service foreign debt, and foreign debt was the trap. By the end of the week, the currency had fallen another 10%. Reserves were nearly gone. Confidence was evaporating. At this point, the public finally noticed, but by then it was too late. The real damage had already occurred inside the balance sheets, behind the curtain where no citizens could see. And then came the fatal blow, the final 5%. That last move wasn't financial, it was psychological. Once confidence snapped, the currency entered freefall territory. Importers stopped buying. Banks refused to lend. Governments scrambled for emergency loans from the IMF. What looked like a regional currency event in Asia and Russia was in reality something far bigger. A global dollar shortage. Few understood it at the time. Fewer understand it now. Every country involved was borrowing in dollars, but earning in their local currencies. When the dollar rose, their debt ballooned overnight. And when panic spread, the world discovered a frightening truth. A currency doesn't break when it's weak. It breaks when it runs out of dollars. Today, we're in an even more dangerous position. Global leverage is higher. Foreign dollar debt is triple what it was in 1998. And dollar liquidity is evaporating faster than almost any time in modern history. The fragility is baked into the system, the speed of collapse is faster, the pressure is greater. And if 1998 taught us anything, it's this. Once the first crack forms, the entire structure can fail in days. Which brings us to the real question, the one almost no one is asking. What created the pressure in 2026? Pressure doesn't announce itself. It builds, quietly, relentlessly, until the system can no longer bear its own weight. And in 2026, that pressure is no longer theoretical, it's mathematical, it's structural, it's unavoidable. For years, governments around the world treated deficits as harmless. We can always borrow more, they told the public. Debt is manageable, economists echoed on television. But the truth, hidden beneath those comforting phrases, is brutal. The global economy has reached the point where nations borrow just to repay previous borrowing. This isn't growth, it's financial cannibalism. When debt compounds faster than GDP, the machine needs ever larger amounts of capital simply to stand still. And that dependence, on foreign lenders, on international creditors, on dollar markets, creates the exact vulnerability that detonated in 1998. Only now, it's bigger, deeper, more synchronized. The first sign appeared in government balance sheets. Deficits didn't just rise, they exploded. Countries that once ran modest shortfalls are now running the largest peacetime deficits in history. The US, Europe, emerging markets. Every region is bleeding money. And with interest rates elevated, every dollar of deficit costs more to finance. This is the trap central banks walked into. They raised rates to fight inflation. But those higher rates multiplied government debt costs, which forced more borrowing, which required even more rate sensitivity, creating a feedback loop that no monetary authority can escape without causing damage. In the 1998 playbook, this was the moment capital began to flinch. In 2026, it's beginning to reverse, even slightly, and slightly is all it takes. Because when capital flows reverse, currencies suffocate. In 1998, the Asian and Russian crises were triggered by the disappearance of offshore dollars. Funding that suddenly dried up when investors demanded safer assets. Today, that same dollar shortage has returned, but with a cruel twist. The US dollar isn't just strong, it's dominant, and it's tightening like a vice. For weaker economies, this is oxygen deprivation. Their currencies can't breathe, so they do the only thing they can do: They drain their foreign exchange reserves, selling dollars into the market to defend their currency. And the pace of that draining? It hasn't been this fast since, ironically, 1998. That is not a coincidence, it's a pattern. As reserves shrink, nations are forced into even more dangerous behavior, issuing short-term debt at yields so high they resemble distress signals. These short-term loans keep the lights on, but they also increase rollover risk, the exact scenario that causes sudden, catastrophic collapses. It's a pressure cooker with no release valve. Every nation depends on external capital. Every nation needs dollars. And every nation is competing for the same shrinking pool of liquidity. This is how currency fractures form, not through panic, through math. Today's system isn't simply stressed, it's structurally cornered. The pressure is locked in, the fuse is lit. But here's the part almost no one sees coming. The next major fracture won't begin with governments, or central banks, or even hedge funds. In 1998, a hidden player quietly accelerated the collapse, one whose actions were largely invisible until the damage was irreversible. And in 2026, that same hidden player is showing signs of panic again. And this time, their impact is far larger. Most people imagine hedge funds as the villains of every financial crisis, fast, aggressive, hyper-leveraged. But in 1998, it wasn't hedge funds that pulled the world into the abyss. It was the most conservative investors on earth, sovereign wealth funds. These are the pools of national savings, state-owned investment giants meant to stabilize economies, not destabilize them. Funds built from oil revenues, trade surpluses, pension reserves. They're supposed to be calm, patient, unshakable. But when they move, the world moves with them. And in 1998, they moved fast. When currencies in Asia and Russia reached breaking point, sovereign wealth funds didn't issue warnings. They didn't hold press conferences. They didn't negotiate publicly with central banks. They did something far simpler and far more catastrophic. They dumped assets, equities, bonds, foreign investments. They sold anything that could be converted into dollars to defend their collapsing currencies. And because these funds controlled hundreds of billions at the time, their selling wasn't a ripple, it was a tidal wave. Markets cracked, liquidity vanished. Asset prices plummeted under the weight of forced selling. This was the silent accelerant of 1998, the moment nations cannibalized their own portfolios to survive. Most people never saw it, but traders and bankers felt the shock instantly. Today we're watching the same movie, only with a bigger cast, a larger budget and far higher stakes. Sovereign wealth funds now control over $12 trillion in global assets. They're woven into everything: tech stocks, US treasuries, European property, African infrastructure, Asian manufacturing, private equity, venture capital. A small percentage shift from these giants, just 1%, can trigger liquidity crises across continents. And quietly, without headlines, several funds have already begun reducing foreign exposure. Not dramatically, not loudly, but systematically. Exactly what they did in the months leading up to the 1998 break. They're pulling money home. They're preparing for currency defense. They're bracing for stress. The data is public. The pattern is unmistakable, but the meaning is hidden from most observers. Sovereign wealth funds don't flinch early. They flinch when they see something catastrophic coming. Here's what makes the current moment terrifying. If these funds accelerate their withdrawals, even slightly, global markets will convulse. Because when trillions shift suddenly, every asset class feels the shock. And currencies? They won't simply slide. They will detonate, just as they did in 1998. Only faster, because today's markets are more leveraged, more interconnected, and more algorithmically reactive. The quiet selling we're seeing now may be the opening act of something far larger. Because when sovereign wealth funds panic, they don't call for help. They don't ask permission. They don't warn the world. They just sell. And the world pays the price. But sovereign funds are only the first major domino. The next one, the one that truly transforms a currency crisis into a global emergency, is already wobbling. And once it falls, the speed and scale of the collapse will shock almost everyone. The banking system is beginning to fracture. There is a moment in every financial crisis when the problem stops being out there, in foreign markets, in distant governments, in currencies you'll never hold, and suddenly becomes terrifyingly close. That moment is when banks stop trusting each other. Because when trust disappears between banks, everything else follows. In 1998, the Asian and Russian collapses were initially dismissed as regional issues. Something over there. Something contained. But the illusion shattered the moment interbank lending froze. Overnight, literally overnight, banks that appeared perfectly healthy could no longer borrow the short-term funds they needed for daily operations. Not because they were insolvent, but because no one wanted to take the chance they might be. Interbank spreads widened. Collateral requirements exploded. Cash vanished from the system like someone had pulled a plug. Healthy institutions suddenly became illiquid. Illiquid institutions suddenly became insolvent. And insolvency, real or feared, spreads like wildfire. This was the pivot point in 1998. The moment a currency event transformed into a global, systemic crisis. Now look at 2026. The same stress indicators that preceded the 1998 freeze are flaring again. And they're flaring all at once. Banks are hoarding cash, not lending it. Overnight funding costs are surging. Counterparty risk models are being quietly updated behind the scenes. Even the largest global banks are demanding pristine collateral, U.S. Treasuries only, and smaller banks simply don't have enough. And here's the uncomfortable truth. A bank that can't borrow is a bank that can't function. Once the interbank freeze begins, the scramble for dollars becomes a panic. Every bank, in every region, rushes to secure liquidity at the exact same time. This is what creates the acceleration effect that turns a slow-burning crisis into a violent one. Because when everyone needs dollars, the dollar becomes a weapon. Central banks then step in, hoping to calm markets. Repo injections, emergency swap lines, liquidity backstops, all the familiar tools. But these interventions have a dark side. Every time a central bank intervenes, it signals to the world that the system is weaker than they admitted, and that signal accelerates the panic. The 1998 script is playing out scene by scene, and in 2026, we're already in the early stages. The trust is fading, the freeze is forming, the scramble is beginning. Most people won't see it until it hits the front page. By then, the damage is already irreversible, because the banking system is the bridge that connects all markets. And once that bridge begins to crack, the collapse spreads faster than anyone expects. But what comes next is the part that shocks the public every single time. It's the reason modern crashes feel instant, sudden, breathtakingly fast. This is the moment markets stop moving gradually and start moving at 5x speed. Next comes the timeline compression, the phase where hours feel like weeks and weeks feel like history. Every generation believes its crises will behave like the ones of the past. Slow, predictable, telegraphed months in advance. But today's markets don't collapse the way they used to. They accelerate. They compress. They move at a speed the human brain was never designed to process. And the reason is simple. The system has removed all friction. Back in 1998, markets still had natural brakes. Trades executed more slowly, information traveled imperfectly. Leverage was limited by technology, regulation, and infrastructure. Even then, the world was shocked by how fast things unraveled. But compared to today, 1998 might as well have been a different planet. Now we live inside an always-on financial machine. Markets trade 24/7, news spreads globally in seconds. Algorithms execute trades in microseconds, long before any human can react. This is what makes crashes today move 5 times faster than they did in earlier eras. Timeline compression isn't an accident. Timeline compression isn't an accident. It's built into the architecture. The instant markets detect stress, volatility spikes, yields rise, liquidity thins. Algorithms don't pause to think. They act. And when they act, they do so in perfect mathematical coordination. Imagine thousands of automated systems, all scanning for the same signals, all trained on the same models, all concluding the same thing. Reduce risk, cut exposure, move to safety. And because they make these decisions simultaneously, markets don't decline gradually, they fall off a cliff. This is the synchronized exit phenomenon. One small move becomes a cascade. One shock becomes a stampede. One data point triggers 1,000 sell orders. A 20% move that took days in 1998 can now unfold before lunch. And this new reality matters more than ever in 2026. Because the precursors to timeline compression, the same indicators that sped up the 1998 collapse, are flashing again. Funding liquidity is thinning. Dollar demand is rising explosively. Cross-asset correlations are tightening. Risk models are converging across institutions. Market depth is evaporating. Combine those conditions with leverage, sovereign wealth fund selling, and a nervous banking system. And the setup becomes unmistakable. The next break won't give anyone time to react. This is why modern crises feel sudden, why markets appear calm until they aren't, why collapses feel instant, even though the warning signs were visible the entire time. Timeline compression is the mechanism that turns cracks into fractures, and fractures into collapses. And right now, the system is primed for speed. Every signal that mattered in 1998 is not only present, it's amplified, which leads to the unavoidable question. If the signals are flashing and the architecture is primed for acceleration, where is the proof? It's there, hidden in the data almost no one bothers to read, and once you see that data, the reality becomes impossible to deny. If you want to know where a currency crisis is heading, don't look at the headlines. Headlines are theater, crafted to reassure, to distract, to delay. The truth lives somewhere else entirely. It lives in the footnotes. In the tables no one reads, in the charts buried at the end of 200-page reports that only a handful of analysts ever open. And right now, those footnotes are screaming. The first piece of evidence is the most obvious and the most ignored. FX reserves are falling, fast. Not in small distressed economies, but across major emerging markets. This is the exact pattern that preceded the 1998 snap. Nations quietly burn through their reserves to defend their currencies until the reserves run out. When you see reserves dropping month after month, it means something simple. Countries are losing the battle. But they don't announce defeat. They just keep selling until the tank hits empty. The public never sees this part, but insiders do, and they're worried. Then there's the swap premium spike. This is a technical measure few people understand, and that's why it's so revealing. When swap lines get expensive, it means foreign institutions are desperate for dollars and willing to pay almost anything to get them. In 1998, the swap premium surged weeks before the collapse. Today, it's rising even faster. That's not volatility. That's distress. A third signal, inverted yield curves in emerging markets. When short-term borrowing becomes more expensive than long-term debt, it's a sign that investors are bracing for near-term danger. Bond markets are essentially shouting, "We don't trust the next 12 months." This same curve inversion appeared in multiple countries right before the 1998 crisis. The pattern has returned, more widespread, more synchronized. But the most alarming data point is almost invisible. Record amounts of short-term foreign borrowing. When nations borrow in dollars with extremely short maturities, they create rollover risk, debt that must be refinanced constantly at whatever rate the market demands. This is how countries get trapped. This is how liquidity events become solvency disasters. The IMF knows this, which is exactly why, quietly, without publicity, they recently updated their crisis risk models. Public. They changed variables that only shift when the odds of collapse rise sharply. It's the closest thing to an institutional alarm bell you'll ever see. And it's ringing. Meanwhile, central banks are engaging in an even more desperate maneuver, rolling over short-term debt at record levels. That means they're not paying debt down. They're not extending maturities. They're simply refinancing, again and again, hoping markets don't notice the rising stress. But the data is there. Public. Undeniable. The system isn't navigating volatility. It's brittle, fragile, a structure held together by pressure and prayer, and brittle systems don't bend. They snap. And when they do, the consequences don't stop at currency charts or bond spreads. They spill into the real world, into prices, into banks, into jobs, into governments. We've now reached the inflection point where the data is no longer just a warning, it's a countdown. Because the next phase isn't theoretical, It's what actually breaks when a currency breaks. A currency crisis is not an economic event. It is a survival event. And almost no one understands how fast life can change when the value of money shatters. People imagine a currency break as a chart on a screen, a dip in an exchange rate, a news headline you scroll past. But in reality, it's the moment an entire society gets repriced. Instantly, violently, without warning. Because when a currency breaks, everything breaks. The first shock is always imports. Overnight, the cost of foreign goods surges. Not gradually, instantly. Fuel prices jump, food shipments stall, medical supplies become scarce. Replacement parts disappear from warehouses. In 1998, these shortages appeared within days. Entire industries, from manufacturing to pharmaceuticals, collapsed before governments even understood what was happening. Stores didn't just raise prices, they removed items from shelves because suppliers refused to deliver without payment in a stable currency. And households, they were blindsided. 1 week, life was normal. The next, basic necessities cost 30%, 50%, even 100% more. That's what a currency break actually looks like, but the real danger comes from debt. Most countries borrow in dollars. Most companies borrow in dollars. Even many households, indirectly, rely on dollar-denominated supply chains and financing. So when a local currency loses 20% of its value, those debts don't just become expensive, they become impossible. Suddenly, corporations that looked profitable are insolvent. Banks holding their loans panic. Credit evaporates. Withdrawals get restricted, not because banks are failing, but because they fear everyone else will. This is how financial systems spiral, not from real losses, but from the fear of losses. Governments respond exactly as they did in 1998 and exactly as they will in 2026, by imposing capital controls, limits on bank transfers, restrictions on foreign exchange, frozen accounts, mandatory conversion rules, emergency decrees that punish anyone trying to move money abroad. They blame speculators, they blame foreign adversaries, they blame temporary pressure. But the truth is simpler. Once confidence breaks, policymakers lose control. In 2026, the consequences will be far more severe. Supply chains are globalized. Debt levels are extreme. Just-in-time inventory systems mean there is no buffer, no cushion, when prices spike. A 20% currency break today won't just hit markets. It will hit households instantly. Gas stations will reprice before sunrise. Grocery stores will change labels midday. Pharmacies will ration imports. Businesses that rely on foreign components will fail in days, not months. Banks will face runs. Credit cards will stop clearing. International trade will cease. And as always, governments will say they have things under control. As always, they won't. Because society doesn't operate on money. It operates on confidence. And once confidence collapses, society reorganizes itself around the new price of survival. This is the phase every crisis reaches before the end. Because after the chaos, after the inflation, after the panic, something else always emerges. Every collapse eventually burns itself out and resets the system. A currency crisis doesn't end when the chart stops falling. It ends when the world reorganizes around the new rules. Rules written not by voters, not by markets, but by who survived the collapse with power intact. Because currency breaks don't just liquidate wealth, they rearrange it. They redraw hierarchies, alliances, and global influence in ways most people only understand years later. After the 1998 snap, the world didn't simply recover, it restructured. New financial alliances formed across Asia. Nations that had depended on Western capital began building their own regional frameworks. Central banks rewrote their mandates. Currency reserves shifted. Trade routes realigned. And the countries that walked into the crisis with strong reserves and strategic exports emerged with more leverage than before. Meanwhile, those that entered dependent on foreign money lost something far more valuable than GDP, autonomy. This is the hidden aftermath of every currency event. Crises don't destroy power, they redistribute it. And in 2026, that redistribution will be far more dramatic. The world is already signaling the outlines of the next monetary order. New reserve currency agreements. As trust in the existing structure fractures, nations will seek diversification, multiple anchors instead of a single one. This doesn't kill the dollar, but it dilutes it. It turns the global monetary system from unipolar to multipolar. Regional trade blocs. Countries will increasingly trade within currency-safe zones, groups that share settlement systems, funding pools, and swap lines. The EU has one. Asia will accelerate its own. The Middle East is quietly building another. Digital settlement rails. Blockchain won't replace money, but it will replace infrastructure. Nations need cheaper, faster, verifiable cross-border systems that don't rely on legacy American-controlled networks. Expect CBDC corridors, regional payment rails, and hybrid digital reserve assets. Capital barriers. Just like post-1998, governments will raise walls to prevent the next crisis. Tighter capital controls, restrictions on foreign ownership, mandatory reserve rules, limits on speculative flows. These measures don't stop crises. They signal that the system has already changed, and as always, the winners and losers will sort themselves by one simple rule. Those with resources, reserves, and self-sufficiency gain power. Those dependent on external capital lose it. A country that controls energy, food, and industrial inputs becomes exponentially more influential in a post-crisis world. A country that relies on foreign borrowing becomes exponentially more fragile. Most people won't see this shift until it's complete. By the time the public realizes the world map has changed, the new alliances will already be signed, the new currency arrangements already in motion, the new trade routes already operating. Currency breaks don't just move markets, they move empires. And now, after tracing the build-up, the break, the acceleration, the collapse, and the reset, we reach the final question. The one that pulls every thread together. What does this reset mean for the years after 2026? There's a moment right before every major financial rupture when the past and future collide. A moment when history stops whispering and starts repeating. And 2026 is that moment. Because 1998 wasn't an anomaly, it was a warning. Not a story about emerging markets, or speculative funds, or political turmoil, but a story about mathematics, pressure, and inevitability. A story about what happens when a global system stretches further than its architecture was ever designed to support. And now, after decades of ignoring that warning, the pattern has returned, amplified. History shows that currency systems don't fail randomly. They fail on schedule, when structural pressures line up with predictable precision. In 1998, it was leverage, foreign debt, weak reserves, and a tightening dollar. In 2026, those same conditions exist, but at multiples of their former scale. Debt is larger. Deficits are wider. Liquidity is thinner. Leverage is deeper. Dependencies are more dangerous. The system that cracked in 1998 is now a larger, more interconnected version of itself, one that moves faster, reacts faster, and breaks faster. Most people will never see the build-up. They will only see the trigger, the event they'll blame for the collapse. A geopolitical conflict, a failed auction, a sudden default, a surprise interest rate move, a hedge fund blow-up. But the trigger is never the cause. The cause is the structure. Crises don't happen because something went wrong. They happen because everything was already wrong, and the final straw simply revealed it. By 2026, debt, deficits, and liquidity strains have crossed their mathematical threshold. Governments can no longer borrow without consequence. Central banks can no longer stabilize without cost. Banks can no longer rely on markets that no longer trust them. This is the point of no return. A currency break, whether 10%, 20%, or more, is not a possibility. It is a release of pressure that had been quietly accumulating for years. And the speed of that break, that part is new. With timeline compression, algorithmic leverage, and globally synchronized risk models, the fall that took days in 1998 could unfold in hours today. A 20% snap is no longer dramatic. It is realistic. The question is no longer, could it happen? It's, will the world recognize the cracks before the snap becomes irreversible? Because once the first fractures appear, Once reserves fall too fast, once swap lines surge, once withdrawals tighten, once confidence evaporates. The system enters its final predictable phase, a phase where nations blame each other, where central banks sprint to keep up, where markets move at unhuman speeds, where households feel the consequences instantly, where governments lose control of the narrative, a phase we've seen before. A phase we were warned about. 1998 was not a lesson, it was a preview. 2026 is not a rumor, it is a test, a real-time examination of whether the world learned anything from the last time this script unfolded. And right now, every indicator suggests the lesson was ignored. The pressures are back, the patterns are repeating, the architecture is groaning, and history, once again, is right on schedule. Because systems don't fail because of chaos. They fail because the math demands it. 1998 was the warning, 2026 is the test, and the test has already begun.